We're here with Gary Volman and Rishi Dhir. Thanks, guys, for joining the CFO Hive podcast. How are you?
Excited to be here.
Awesome.
Awesome. Well, thanks for having us, David. Really excited for this conversation.
Yeah, likewise. This is officially the first recording with more than two people. So one, that's me qualifying that if anything goes wrong, that's why. But also, I'm really excited about this because you guys are a fantastic one-two punch, bringing different perspectives. And I think this topic is one where, frankly, different perspectives are needed, and there's a lot of folks involved with the world of M&A. And I think a lot of times it's hard to see the big picture and bring some of those perspectives. So from a CFO vantage point, I think just getting inside, the world of, from a legal perspective, from an insurance perspective, and you guys kind of seeing deals would be really great to, get into that. So guys, maybe starting off a little bit of background you guys could provide on yourselves. Maybe Gary, go ahead first and just share with the audience, who you are.
For sure. Thanks, David. Yeah. So I'm a partner in the capital markets group at Airden Burles, which is a full service law firm in downtown Toronto. I've been, since the start of my legal career, I've really been working in private practice at a variety of full service, regional, national, and international law firms. And I think over that duration, my practice has been generally split between capital markets work and M&A work, and now more so focused on the domestic and cross-border M&A transaction side of the corporate law world. I focus on working with clients at all levels, really domestically and internationally, small companies, entrepreneurs, startups, medium-sized companies. Like really our bread and butter here is the mid-market, which could be broadly defined, but it covers off a lot of different type of M&A transaction and mandates, and large clients as well who are publicly listed and doing some of the larger transactions that we sometimes see in the news. Only other thing I would say is pretty industry agnostic. So working in different areas, whether it's tech, manufacturing, agriculture, mining, and that's what I enjoy so much about what I do on a day-to-day basis. It's dealing with different businesses, different industries, and I love that sort of learning aspect of it, where there's just something new that comes up, whether it's in a transactional context or kind of more day-to-day corporate stuff. There's something new to tackle every day on the job.
You're not getting bored too often. Hey,
right.
on the mid-market note, I'm just really curious how you define that. And I know you said it's a broad range, maybe not easy to define, but is that tied to revenue or deal size? How do you think of mid-market?
I think in my world, a lot of it is tied to, and I'll let Rishi speak from his world, but probably more so deal size, like the enterprise value of a transaction. So I don't think there's like a perfect sort of box around it, but I would say like anything, in the 50 to 250 million range, you're pretty square in the mid market, but it could be broader than that. So that's generally sort of the playground, so to speak, that we play with. But again, we would do smaller deals than that, many smaller deals, and we do larger deals as well.
Yeah, awesome. Rishi.
Yeah, mine career is a little bit of a journey. So this is, I would call, the third stage of my career. My first stage started off at Microsoft Canada, where I was really focused on operations. And after doing that for a bit, I decided to go to law school. Really was excited about the M&A space. So went to law school and started working at a law firm called Stikeman Elliott. And I was there for just over 7 years, focused on both public and private M&A transactions across a variety of verticals. So touched on clients from tech to mining to telecoms and everything else in the middle. And then last year, I decided to take the plunge and head over to the insurance side, but still keeping that M&A theme going, which is what I get personally excited about. So now I help my clients ensure their M&A transaction and manage risk in M&A transaction by leveraging a variety of insurance products, the largest one of which is called rep and warranty insurance. We work with clients similar to Gary of all shapes and sizes, a lot of private equity funds, but also a lot of strategic clients as well, across a variety of deal sizes as well. So, going to 8 to 10 million enterprise value range all the way up to billions of dollars. And we will look to ensure transactions within that entire spectrum.
So down to 8 to 10, what is that defined as? Is that lower mid-market or is that just low market? Like where's the bottom here? And I'm trying to understand, because even lower mid-markets kind of seem to take on this space that folks are gravitating towards.
Right.
And I suspect it's just there are a lot of businesses that are just below that traditional mid-market line. Is that sort of 8 million up to the 50 million range?
Yeah, it's interesting. In Canada, there's a ton of M&A activity that's kind of happening in that sub 20 million enterprise value range. So what I do now in terms of providing insurance and managing risk for these M&A transactions, a lot of this wasn't even available for this entire marketplace until about a year and a half ago. And that was really driven by the pricing of this product. Given where the pricing was, it was really limited to, deal sizes of what Gary defined earlier as your typical mid-market, meaning 50 million and up, just given where the pricing was of the product. But in the last year and a half, as the M&A market slowed down over the last couple of years, the pricing also came down, which made it open and available for what, as you rightly define, lower mid-market, which is a lot of the deals in Canada. And that's what's really helped grow this industry in Canada over the last couple of years as well. Got
it. So relatively new, more predominant in the US, is that right?
That's right. So US, it's kind of at the maturation stage at this point. It's a majority of the transactions in US utilize rep and warranty insurance. Obviously a higher percentage when it comes to private equity transactions, but also on the strategic side. In Canada, we're not at the majority when you look at the entirety of the landscape, but if you just focus on private equity, it's still a majority of the transactions. It's the strategics that are really also utilizing the product and increasing amount lately. So we've definitely seen an increased adoption as the pricing have come down, as people have become more familiar with the product, the buyer base has evolved and become more comfortable as people have gone through a few claims cycles utilizing the product and realizing that it does pay, and there's a lot of claims that get paid. So all of those factors, and COVID was a real accelerator for that in Canada, with all that, the deal activity that we had and how quickly deals needed to get done and the power that the sellers had as part of those transactions. They essentially wanted a walkaway deal. They wanted buyers to come to the table saying, you will have rep and warranty insurance. We will not be providing any indemnity. And because how competitive the marketplace was, it really helped accelerate the adoption in Canada as well. And we have seen that trend continue in an upward trajectory.
Yeah, awesome. Gary, you're a fan?
Oh, absolutely. So listen, I mean, I think it's one of those things, and I'm sure we'll get to more as part of this discussion, where we're seeing it come up more and more, right? Certainly adopted earlier and more pronounced in the US market, but in the Canadian market, if I even think about, the transactions that have been on, over the course of the past couple of years, I could comfortably say the majority of them have the rep and warranty element. So it's, to Rishi's point, I think it's something that we're seeing an uptick of, and I expect only, more and more of it, especially in the market where we are and in that sort of mid-market transaction space, for sure.
Awesome. So we talked a bit about, where the market was. Rishi, you mentioned COVID, and it seems like we've been in this slow stage for the last couple of years, but everyone's talking about, the activity that's going to come. A lot of capital on the sidelines, coupled with sort of demographics and where M&A activity is anticipated to be. A lot of companies changing hands over the coming years. And then private equity with all the dry capital for 2025, people are saying floodgates are going to open. I'd love to hear from you on your expectations around the market. Where are we now and what are you seeing around the corner? So maybe Gary, you can start with your sense of the market.
For sure. So we're definitely seeing M&A activity heating up. Like I would say, as we got to the end of the summer and crossed Labor Day, sort of that time period, just a couple of months ago, like there's been a bit more of an uptick. Deals that have been in the pipeline for some time have started moving forward. It's making for busy year ends for many in the corporate marketplace, and also setting the stage for 2025 ultimately to be a busier year. We're certainly not at those peak COVID levels that we were just discussing. Especially in light, like, to your point, David, like geopolitical activities, right? Whether it's the interest rates and the projections around those continuing to drop. We literally are less than 2 weeks away from, a pretty huge election just south from the border from us. And, that's, people are waiting to see how that's going to unfold. So, I think the best way I would summarize it is that certainly an uptick, a lot of encouraging signs, and just a general sentiment that M&A activity is picking up and is anticipated to continue picking up.
Rishi, before we go to you on that, on your perspective, guys, on the election stuff, is it true that like everyone's waiting for the election and everyone's talking about it, but then once it happens, regardless of who wins, like people sort of operate the same way? So it just makes you wonder, what are we waiting for? Is it just like why so much uncertainty if we're just going to go do the same thing? Maybe a quick response there, and then Rishi will go to you.
Well, listen, I think it's one of those things where policies take time to come into effect, right? And so we'll obviously see, depending on the outcome of the election, what policies are going to be pushed forward. But because of how like global and international a lot of the transactions are nowadays, where there's elements in a transaction where it's not just Canada to Canada deals, and in fact, most of the deals I do are US originated in many cases and may just have a Canadian element to them, but the primary target may be US and have a Canadian subsidiary or something like that, that it doesn't actually surprise me that we're inherently sort of tied to that in terms of seeing how policies in the US may impact Canadian markets. Usually things that happen in the US on the corporate front, we tend to follow or lag a bit after and follow. So it's a fair point, David. I think from my perspective, though, it doesn't really surprise me that there is that bit of sort of hesitancy just to see, because at the end of the day, people want certainty when they're pricing transactions, and whether that's rates, whether that's politics, whether that's global matters that are going on, things that may impact that. We honestly see that at the transaction level. And so the more certainty that can be had at the transaction level, the more you're going to see the transaction process streamlined, at least from my perspective.
Yeah, makes sense. Rishi, what do you think?
Yeah, I agree with a lot of what Gary said. I stopped personally predicting the market about a year ago when every quarter, people were thinking that the next quarter is when it will pick up. What I can share is from our clients, what we are hearing, there still remains a gap between the seller's expectations of value and what the buyers are willing to pay in this marketplace. And the deals that are getting done are taking typically longer to get done than they were earlier. So that means that there's a lot more focus on diligence, and buyers are being a lot more prudent when it comes to M&A activity, which is very good if you think from a market perspective, as opposed to when deals were getting done in a couple of weeks. And I agree with Gary's point about stability. I think a lot of the buyers are looking for stability in the marketplace, that they have some expectation as to once the deal closes, what the go forward looks like. So in the Canadian space, I think in the last 3 quarters, we've seen some consistency in deal volumes, which is all helping in the current marketplace that we are in, where there's an excitement, there's energy that, more and more deals are coming to our desks. And hopefully that will mean that more and more deals are getting closed as we kind of go and transition into 2025. But like I said, I stopped predicting last year, so it'll be a wait and see approach from my perspective as to how that evolves. But all the signs as to what we're seeing are positive. which is exciting for us.
When it comes to getting ready for a deal, an acquisition or selling one's business, just maybe from the perspective of a business owner, what are some of the steps they would take initially? They sort of have the ambition to make an acquisition. Who are they calling first? Gary, is it you? And then, the team starts to get assembled. Give me a sense of just sort of who's, the first to get in touch with the business and start setting it up, and then kind of how the team forms around getting a deal done.
Yeah, it's a great question, and I think the answer has a bit of a it depends element. Like depends on the company, depends on the opportunity, the type of transactions. Like there's companies that can engage M&A advisors at a very early stage to run an auction process, for example, right? So if it's an auction bidding process, oftentimes like I find that the M&A advisor may be engaged in first instance by the company along with the accountants, right, to prepare the financials, latest financials and all that as part of the disclosure process, and then legal may be engaged sort of after that process, right? As opposed to if it's a more direct engagement process between a buyer and seller, from a legal standpoint, we tend to get engaged quite early because often our input is sought on the LOI process, the letter of intent process, right? Just so that, legal eyes run through that so that it minimizes deal friction down the road, right? So we try to pin down the key terms of the transactions up front as early as we can, and there's a lot of value for that for clients. So I think it's a good question, David. It's a bit contingent, but there's an external element of it that I see in terms of lining up your advisors depending on the nature of the deal, and then there's also an internal element which we're aware of. We don't actually see as much of it on the external advisor side, but it's really like how do you set up your communications internally from a management standpoint, because there is going to be a disclosure process, but at the same time, the company needs to continue to run in its ordinary course. And you need to think about things like confidentiality and key employees and, disclosing information on your key customers, key suppliers, and things like that. So you need to have, appropriate like owner management involvement in that process. That's actually a very natural opportunity for some companies where like fractional services could come in, whether it's at a CEO, CFO level, CLO level. And so it's kind of those two things really need to go in parallel, in my view, between the internal preparation that a company undertakes before a potential M&A mandate, and then of course the external support that they're going to engage.
And much of what you're speaking of, some of that sounded more specific to a sell situation, but you gentlemen cover both the buy and the sell. And so I guess, Rishi, for your type of offering, you're actually helping both the buyer and the seller. Who's bringing you into that process? Either one or both?
Yeah. So predominantly, we are engaged by the buy side. Most of the policies that we placed are being bought by the buyers to cover the representations being provided by the sellers. Granted, there are also sell side policies, and there's been a little bit of a resurgence on the sell side policy front as well. But I would say our key the key buyer base has been the buyer side. So buyers, bring this in at different stages, as Gary pointed out, depending on the nature of the transaction. If it's an auction, usually we're coming in that phase 2 stage. So once the buyers clear the phase 1 and moved on to phase 2 of the auctions, they will bring us in to get a better understanding of what the terms look like, pricing, deductible, heightened risk, so on and so forth. If it's a non-auction process, we typically get brought in as soon as the LOI is signed, so that we can go out and start the process for rep and warranty insurance as well. So it very much depends on the deal.
Got it. But fair to say, is it valid that the seller benefits as well, in that the buyer taking risk off the table? Hopefully that gets reflected in a higher price paid to the seller. Is that fair to say?
Yeah, no, that's so historically, the product was very much looked upon as, hey, it's benefiting the sellers because the sellers get all of the money up front. They don't have to leave money in the escrow. And therefore, it's a real benefit for the seller, and buyers were buying the product to help them as part of negotiations with the seller. Because a seller, if they have two options, one is indemnity escrow versus somebody coming in saying, hey, we'll get rep and warranty insurance, you get all the money up front. Seller, no brainer, will be picking that option too for them, all the rest of it being equal. However, as the products evolved, there are, buyers have realized that there are some key benefits that rep and warranty insurance provides to them that otherwise is not available to them under a typical indemnity structure. And that's why it's not even as much being driven by the sellers. Granted, sellers drive definitely a lot of the adoption, but by many buyers themselves, are putting rep and warranty on every single one of the deals that they're doing. In fact, to signify that, the benefits of it, you can see that there's been an increased adoption in take private transactions. So take private, a transaction where buyer actually has no recourse against the seller, historically has had no recourse against the seller. Now, buyers are buying rep and warranty insurance even on take private transactions because they recognize the value for it for themselves. So what is that value? There's quite a few of them, but I'll touch on two key ones. The first one is many times in these businesses, especially on the private M&A world that we're talking about, the sellers remain involved in the business in some capacity after the business has been bought. So whether it's through some kind of consulting arrangement, some employment arrangements, or even they might have a rollover, so they have an equity interest and they're still working in the business. So in a typical indemnity structure, if you figure out, hey, after the deal's closed, there were some misrepresentations or breaches of representations that were provided, now you have to go make a claim against a seller. And this is a seller that's still involved in the business. So you're in a way harming yourself, right? And the buyer always has to go through this equation in their mind. Well, should I go forward with a claim or do I just absorb it? Because I do not want to create this friction, right? With somebody that's still playing a key role in your business. But now when you have rep and warranty insurance comes in, you're making that claim against an insurance company, right? So there's nothing that's impacting that relationship vis-a-vis the seller. And that is a very, very important benefit that shouldn't be overlooked by the buyers at all. Because when we talk about holistic risks in M&A, there's obviously financial risks, but a lot of the, when you look at the top three risks, people risk always forms part of the top three risks. And people risk is culture fit, how is the leadership team going to work alongside the buy side team? And if you start adding friction to that at the outset, that obviously has a negative impact on your financial returns in the long term. So that's one of the big risks that get taken away when you have rep and warranty insurance. Typically in an indemnity structure, and Gary can correct me if I'm wrong, but you have recourse against seller for 12 or maximum 18 months in this marketplace, right? So after a deal closes for general reps, if something happens and you realize after 12 months of closings, you can still make a claim against the seller. But what if something comes up after 2 years, right? Our data, when you look at rep and warranty insurance claims data, suggests that that's true, that majority of the claims do come in within the first 12 months, over 50% of the claims. But there's still about these 30 to 40% of the claims that come in after the first year of closing. So all of those, as a buyer, you're not able to make a claim against the seller if you're using a typical indemnity structure because the survival period in the purchase agreement has elapsed at that point. Versus in a rep and warranty insurance, your survival period for general reps is 3 years, and for fundamental is as long as 6 years. So you have a longer period. You've gone through a couple of those audit cycles. You've gone through a couple of those annual financial statement processes to figure out, hey, were there any representations that were made that might not have been accurate at the time of closings? So it's more peace of mind for a CFO, for a buyer, when they're doing an M&A transaction.
Just to unpack on the claims, what are some specific examples of claims that might come up?
Yeah, that's a great question. So the top three claims that we see coming up are breaches of financial statement rep. So under rep and warranty insurance, just like any other indemnity, you get financial statement representations, true and accuracy, and the fact that financial statements have been prepared in accordance with GAAP or IFRS. So breaches of that rep remains the number one claim driver. But if you really distill that down, you realize that as much as it's a financial statement breach, the fact patterns touch on different line items in a financial statement, right? So because ultimately it's either your revenue is reported higher than it should be, or your expenses are reported lower than they should be. So they have a bigger story in the back end. What I would like to touch on is probably, and more applicable to your audience, are the other two types of claims. So the second largest ones that we see are breaches of material customer reps. So this is where there's been a non-disclosure by a seller of some disputes or weakness in relationships with material customers. And that is only found out after the closing has occurred. And we have seen an increased activity, an increased number of claims being reported for breaches of material customer reps. So the guidance there for, the CFOs and buy side teams has been to do, a thorough diligence exercise when it comes to material customer reps. And there's a variety of ways to do it. And even the insurers are requiring that on many of the transactions. So whether it's you're asking a lot of detailed questions of the sell side, you're doing direct customer calls with some of the key customers, that's been an increased ask by the insurers on some of the transactions, or you're doing some kind of a market study to address that. But really the goal is to distill those relationships and figure out the strength of those relationships, because you don't want to be in a scenario after you've bought a company, it turns out one of the customer either renegotiating the terms or completely stepping away. So that's been the second biggest driver. The third biggest drivers are tax breaches. So think about you didn't file appropriate sales taxes in certain provinces or states in US because you have a global business or you're operating North America wide, but you might not be aware that, hey, I need to file taxes in New York State or whatnot, even though you're a Canadian business. So that's probably the third driver of claims that we see.
Yeah, very helpful. Gary, you want to add anything?
As Rishi was talking, it was just resonating with me where, like, even on a transaction that we did last year, as it pertained to the second point that Rishi had with the customers, we actually did have a situation where we were acting for buy side, and there was an outright breach of a material customer rep where a key customer, the seller knew that. Well, sort of after proceedings, we sort of found out that the seller did have some knowledge as it pertains to a key customer actually terminating a relationship with the sell side that wasn't disclosed. There was not rep and warranty policy in place for that particular transaction. And so it effectively made for a bit of a messy scenario post-closing, right? Because there was a lot of work that had to go into assessing what the damages were because of that, in terms of how important that customer was to business as a whole. And the way that the agreement was negotiated for that one is that we really had arbitration proceedings to manage this kind of a breach. And so, a year later, they were still, trying to resolve this through a complicated arbitration mechanism where just more issues sort of started to evolve and unfold as part of that. So all that to say is it could get quite messy when you don't have, the right structures in place to support these kind of potential risks as part of M&A transactions.
Guys, what about like when people make claims or future-oriented information, future-oriented financial information? So when you talk about the reps and warranties that I'm hearing of now, or the representations on customers on financial statements, that's historical in nature, but we're all telling a story and projecting what's going to happen. How does that factor in here in terms of risk assessment and protection?
Yeah, that's a good question. So, you're absolutely right. A lot of these indemnities or rep and warranty insurance is backward looking because you're providing reps as to how you have been operating the business. It's really hard to insure or protect the go forward projections, right? So from a buyer side, I think a lot of that comes down to the advisors that you have, as well as your internal buy deal team, because that's what you're validating. You're validating not only by looking at historical operations of the business, you're looking at the management that's in place in the business. When I talk to my clients, when I ask them, hey, when you're looking at a SIM and that's been sent to you, what are some of the key things you're looking at to figure out if you're interested in that business or not? And most of the times I hear one of the top three things, they scroll down to the management page to figure out the quality of the management and how long they've been around and what their expertise looks like, because that really determines what the business on a go forward basis will look like as well. And then the other part of what I would highlight there is that's exactly, I think, why we're seeing some of the deals in this current market. When as a buyer, you have a little bit of the luxury of time. People are taking that time to validate some of those projections. So you might start a process, say in the summertime, but if you're not closing that until October, November, you have the benefit of a few more months to really validate, hey, we were told these are the projections for the next few months. Have they really played out? By the time you're getting to signing of the transaction. So even that diligence time, you get a pretty good insight into the management's ability to forecast and whether those numbers are being hit. And if they're not, then you see the purchase price being renegotiated by the time you're getting closer to signing, because the projections are not turning out to be as accurate as you would have hoped from a buy side. So in this marketplace, I think you would have a better opportunity to validate some of that even throughout your diligence process.
I'll just jump in there to say I could definitely attest to that. In terms of that question, David, a lot of that front end thinking, to Rishi's point, goes into valuing the company and ultimately feeds into the purchase price, right? So we start with a purchase price that's based on certain assumptions as set out in an LOI or an understanding document between the parties, right? And it's very interesting to see that as the transaction unfolds, and this is where diligence becomes so important in any M&A transaction, because as you get disclosure, as you get a better understanding through the passage of time in a transaction, you really start to see where the deal issues start to emerge that ultimately impact the purchase price. And depending on how a transaction is structured, it could either be like a headline purchase price type of implication, or what I see often with clients when we have structures in place that have earnout provisions or holdback provisions, it's going to directly impact that. It's going to impact the metrics that go into ultimately calculating the earnout, because maybe the business is not necessarily performing as strong as initially expected. And so those ratios on the earnout are going to be impacted. Or maybe it's a situation where, if there's uncertainty about a potential issue that arises, for example, like getting a key consent as part of the transaction, and maybe we can't get it by closing, let's say, but it's expected to happen within 6 months. And let's say the buyer's comfortable closing without that particular key consent. I've seen situations where we've attributed value to that and have retained that value through a holdback. That also is impacting the purchase price, right? Because the amount of outlay of the purchase price that's actually paid out on closing is now lower than what was initially contemplated. And we still might get to the same purchase price when all is said and done, but now we have some more qualifications. So it's always interesting to see how, depending again on how a transaction is structured, absolutely this all feeds into that. And that's why we're seeing that as buyers are taking the time to identify those issues, whether it's part of diligence, whether it's part of seeing updated financials that maybe weren't ready at the time that the transaction kicked off. That's all going to feed into the closing timelines for a transaction. And you could see, to Rishi's point, why transactions are just taking sort of a bit longer in that respect, right? Because of course, on the buyer side, we want to flesh all that out before we get to closing. And so if it's going to take, another few weeks or a month or two or so to get there, of course, that's, buyers want to be in that position to minimize risk when all is said and done and make sure that they're maximizing the value of the ultimate purchase and investment that they're making.
Guys, just maybe thinking about the business owner, for example. what do you find the top mistakes or areas that, they've gone down the path, maybe they're selling their business, they're in a process, it's too late to go back, but if they could, they would have done something differently. And whether that's, right before the deal, during the deal, or, years before a deal, and you said, had you done ABC, your outcome would have been a lot better, or the process would have gone a lot smoother. Any thoughts around that?
Yeah, for sure. So from the sell side, my personal view is one of the best things a seller can do is, as even early as a year in advance of when you're thinking about selling a business, is start to think about your own data room, right? You're not putting it out anywhere, but start getting yourself organized internally by setting up what you would consider to be a data room. So gathering up all of your organizational documents, gathering up your customer contracts and any amendments that are happening to that, gathering up your intellectual property, different assets that you might have in place. So really getting organized, I think, is a lot of the battle from a seller's perspective. Granted, you're running a business, you're obviously very, very busy, but presenting a clear view into your business, it helps you quite a bit when you ultimately end up starting the process and the way a buyer is looking at your business. If you are, as a buyer, innately, if you think about it, you're going into a data room and you see it nice and clean, and you're seeing all the stuff that you expect is there and it's been properly done, it just gives you that level of confidence in the business that you might even help with the valuation of the business, as opposed to going in, you're realizing things are missing, it's a little bit messy, gives you an indication that the rest of the business might be operating that way. Because from a buy side, you're really, if you think about what you have to evaluate a business at the outset, you have a SIM that somebody has either sent to you, either an investment bank or a broker. And then once you have kind of gone past the SIM, you might have a management conversation, but you might get access to some initial documents from a data room perspective if you have gone.
Just define SIM for folks in case they need, it's a confidential info memorandum, but it's like a pitch deck. Is that a?
That's exactly it. Yeah. Pitch deck that you might be preparing yourself, or you have an advisor helping you prepare to really present your business, present your, not only what your business has historically done, what's your future growth plans, if there are M&A that you have in the pipeline that's already set up, you kind of highlight all of that. You provide some financial overview in there as well. It actually ends up cleaning a lot of your processes. So it's not so much as you're putting the term like a lipstick on a pig. That's not what you're doing, because by the exercise of you trying to get organized and setting up a data room, you also end up cleaning up a lot of processes that otherwise you might not have thought about. So from a seller perspective, if there's one thing I have heard this constantly from the buyers, that this plays an impact when they're evaluating a business, and it can definitely help with the valuation.
Yeah, great point. It's not just the appearances. It truly does help you go back and, correct aspects of the business, and not just process. I think there's also some optimization. You might identify things that just look a little funny and actually impact, whether it's how you price your products, how you present information on your financial statements, and those can actually really impact like the reality of your business and inform decisions along the way. So would you say that this should be an exercise you start to build towards years out? Again, to the degree that's needed, you don't need a full-on data room, but just getting into that habit early on. Would you say that makes sense?
100%. Yeah. The sooner you can do it, the better it is. And it also, then it's not a lot of work that coming onto you at the same time. You kind of take your time to set up these processes. I'll give you an example. When and Gary can also probably attest to this, when on the legal side, when you're starting your diligence, you would realize many times you see contracts that are provided by the sellers, and you realize, hey, this contract expired like 2 years ago. There must have been an amendment. And then you ask the sell side for that amendment, and they have to go kind of looking, and they don't even realize that somebody mid-level management signed the amendment that never really made its way to the right people. right? So once, if you're setting up your own data room early on in the process, you're setting up some of those processes as well. We have these agreements. Okay, if this one's expired, where's the amendment? Then what's the go forward process for this to make sure appropriate people are looking at these documents that are having a material impact on your business? So you're absolutely right. The sooner the better, in my view.
Yeah, probably a good use case where the fractional CFO comes in, because I do think of sensitivity around, business owners, even capability and capacity of whoever they have on the team. If it's a controller, and they may not really have the wherewithal to understand what that needs to look like and what building a proper data room needs to look like. They may not have time because people are busy. And then you also may not want to communicate, hey, we're thinking about building a data room. It doesn't mean you can't get there in other ways to just improve process, but I think it tends to be something CEOs don't want to share widely with the team. So bringing in that outside support, I suppose, would be a good path.
100%, right?
Yeah.
Like supplementing those skill sets. I think fractional CFO can play such a good role even in the readiness of an M&A process, where, as you mentioned, everybody else is so overworked, and that's constantly we're talking about in this post-COVID world, that you just need a body, and not just a body, but somebody who understands it and can do it appropriately and discreetly.
Yeah. Gary, what do you think?
Yeah, no, I completely agree with all of that. Like I think, to the point that we're discussing, it's really important, whether it's someone who's, dedicated to managing that process, or at least at an earlier stage can provide guidance on that process, right? Because if, for example, if I'm a listener right now, right, and I say, okay, so, I understand, kind of working towards a data room and building that out is going to, save on time, create efficiencies, but like what goes into the data room, like how, like what specifics, right? Like what are some examples? And we've touched on some of those examples, right? But in speaking with an M&A advisor, you're going to get clarity on how to build that out. And like, just as an example, there's usually going to be like an employment folder that's going to have employment agreements, independent contractor agreements. To Rishi's point, if you take the time in advance to look at those, you may see many of those may, either need to be renewed or looked at again. Maybe you actually didn't even have a form in place with certain employees, and you could certainly anticipate that buyers are going to ask about that and inquire into that, because buyers are going to have to undertake an analysis of whether they're going to keep all employees as part of the transaction, or are there potentially some employees that might be terminated, as part of any restructuring or potential synergy visions that the buyer has, right? So building that element out, the tax element that we've discussed in terms of your tax returns, your corporate contracts, your intellectual property. It's incredible how on the buyer side, when we're even running the intellectual property searches, and let's say we're seeing the trademarks, patents, or copyrights that are out there in the public space, whether registered or not registered, how many times like a seller may not even be aware of that, right? Like that's out there, right? And so just doing, the way I think about it is kind of doing diligence on yourself, right? Knowing that in anticipation of and in preparation of the fact that a buyer will be undertaking that diligence just makes for a much better streamlined process. And I've actually been on deals as well. It's more rare, at least from what I've seen, where the sell side actually prepared a diligence report or diligence memorandum on the business and uploaded that for buyers to review. And of course, buyers are still going to do their own diligence and cross-reference to that report and memorandum. And again, it's not a common occurrence, because there's time and costs that go into that, but it just shows you an example of the steps that some sellers do take in anticipation of a process like that, let alone even just building out a skeleton or a framework, right?
Yeah. And speaking of skeletons, it's like skeletons in the closet. Like, it doesn't mean you have to actually correct for everything. You might just have some things that aren't so great, but being forthcoming about it, or just showing that you know about it and have a narrative around it that's thought out, is going to benefit you. If a buyer finds skeletons on their own that weren't disclosed, or the seller wasn't aware of, they're going to assume there are more.
That's right.
Okay.
Exactly.
Okay. Guys, M&A advisors have come up a couple of times here. Are those advisors the majority of the time involved in transactions? And if not, should they be? Just give a sense of who companies are turning to help navigate the process. Other than the two of you, who else is involved?
I think the accounting function is certainly involved again in terms of
Yeah.
like, preparation of financials. Often, if there is, and this goes to the point as well about anticipatory preparation towards of a transaction where oftentimes sell side may need to undertake a reorganization prior to closing, right? That's something that is going to impact transaction timing at the end of the day. So having and often the steps or the structuring may be driven on the accounting side. Legal would document in paper the reorganization steps, but the thought around how to maximize tax efficiency, especially for individually owned businesses, a lot of that happens in the forefront. So engaging at an earlier stage with with your accountants and auditors and advisors is something that we often see. And then again, in terms of the M&A advisory role, I personally see that more so come up in more of an auction process, because a lot of the times that the M&A advisors are the ones that, or investment banks, for example, are going to be bringing in the buyers and bringing in, and raising that demand and the interest in the business, right? So they would be the first to be engaged in sort of a process like that, right? But I think, David, and it probably sounds like a self-serving statement, but engaging, legal and insurance advisory support like Rishi and I at an early stage, or earliest possible stage, is always going to be recommended as the best path forward, because then you get your team assembled at a very early stage, so that you could assess issues at a very early stage across your advisory team, and then prepare in the best way you can for ultimately a transaction. Because one thing, not to pivot too much from the question, but just what I've seen is sell side maybe not even appreciating in a transaction that there's a big regulatory approval aspect that needs to be undertaken in order for the transaction to even be approved, right? You want people at a very early stage to be thinking about those things, and things that are ultimately going to impact transaction timeline. So when parties are discussing what their ideal closing time period is, that it's in as much of an informed manner as it could be. And so getting that advice up front at an early stage from the advisory team is the way you get there.
Yeah, that's a good point on the regulatory, especially in this market, right? It's something to be very, very mindful of. From advisors, I think it's in generally, we definitely see somebody from financial accounting providing quality for earnings and doing that diligence. There's tax advisors doing tax diligence, preparing that memo. Obviously legal is part of that. And then there's more case by case, right? Depending on the nature of the target, what I would say is there's been an increasing use of tech diligence advisors. So as cyber risk has continued to grow, not even just on software businesses, but non-software businesses, buyers are wanting to ensure that you have appropriate tech stack that's been set up and appropriate safeguards in place. So whether that's through cyber insurance, which is one way, but also from a tech stack perspective, you're seeing increasing use for tech diligence coming in. And then, environmental exposure, you'll get your environmental advisors doing phase ones. Market study is also another one that we're seeing, and background checks on the sellers. That's a key one as well.
Interesting. And might that extend to privacy security when you talk about the tech side as well? Companies where that's a major dependency, for instance, I presume that would be a part of all of that.
That's right. Yeah. So a lot of the time, legal counsel will do the privacy diligence as part of IP diligence and privacy as part of their diligence scope. And then you have external advisors who might be looking at the IT infrastructure of the business and doing vulnerability testing on it and code-based testing to figure out if there's any potential risk there.
Okay. So lots of risk, a lot of players involved. Maybe just help our audience understand how the two of you collaborate. You two know each other very well. Um, I'm sure you've done some deals together. Um, but whether it's you two or the likes of you,
Yeah.
how does that collaboration look? How do you balance financial and legal risks? And maybe just give a bit of perspective on that.
Yeah, for sure. So, legal is such an important backbone of the transaction, right? Any transaction, M&A transaction that's happening. So us as M&A insurance advisors and individuals that are helping place rep and warranty insurance, and also potentially post-closing insurance like D&O tail, and or if there's any insurance required on a closing basis, we are working seamlessly with legal from the very start of the process till the very end. Gary and I would be working when we're going out to the market for insurance terms and working together on that to ensure that the agreement appropriately is reflecting the terms as well, vis-a-vis the rep and warranty insurance that they might be seeking. So if it's no seller indemnity, there's limited seller indemnity. How does that impact your indemnity section of the agreement, all the way to policy negotiations, underwriting process to the point of close. It's a very collaborative approach that happens between legal and our function alongside with the buy side team as well.
Yeah, I completely agree. I see it as a very natural synergy process because I think ultimately what we're both trying to achieve is an outcome for our clients that, minimizes any friction in the deal process and, provide sound advice on risk allocation for M&A transactions, right? And we're approaching it maybe from two different angles, but with the same goal and objective. So, from my perspective, working with someone like Rishi, who's very practical, who's client focused, in dealing with clients is a very effective way to get to their, desired end result at the end of the day, right? You want people who are practical, who are not going to put up barriers, right, to ultimately get to closing, and that are able to manage parties in times where they're at sometimes peak stress levels, right? Because M&A transactions could get quite stressful, especially for people who, may be going through their first and only business sale, right? And so the more experience that you could tap into to guide those clients along, whether on the buy side or sell side, is invaluable. And it's certainly invaluable for me because, as we talked about at the outset, rep and warranty is coming up more and more on transactions, right? And we are also on the legal side being asked a lot of questions on the rep and warranty side, right? And so being able to, whether it's looping Rishi in when we're on the buy side to have those discussions, or maybe if I'm on the sell side and there's already a broker engaged on the buy side, to be able to tap into Rishi's expertise and knowledge to then better advise my clients as part of the process when they're going to me with those questions. That's extremely important and will only become more and more important as we see more rep and warranty deals come up. It'll be a busier 2025. So
yeah, great. So what else would you want to impart on the audience and share that we maybe haven't covered but you think is relevant? Maybe Rishi, start with you.
Yeah, I think the good point to touch on is on the fractional CFO stuff, right? Like where we're seeing that and how that could play and does play a role on transactions. So my first experience with fractional CFO was when I was a legal counsel, probably back in 2017, 18, where they were brought in to help a company go public through an RTO process. It was a very focused role. And, it's a specialized individual that has done it before, knows how to work with advisors around, manage a lot of advisors. It's a lot of work to go through that process. And we successfully took the company public through RTO at that point. So I think there's a increasing demand and role that fractional CFOs will continue to play and will play in a meaningful role because, we all look at the data, especially in Canada, all the businesses that are supposed to change hands in the next decade. And there's going to be a lot of that. And not a lot of business on the strategic acquirer side have built out their M&A functions because they've naturally just grown organically. And when you don't have those functions built out and M&A has historically not been part of your strategy, it can be very stressful for internal teams to manage that process. So a role of fractional CFO, somebody who's gone through M&A processes in the past, to some of the conversations that we were earlier having, be able to drop in with that expertise and really take control and charge of that. You can definitely see space for that. And to draw an analogy on the legal side, and Gary can talk even a bit more about that. We're seeing similar thing happen on the legal side, where this fractional general counsel type of role is evolving, where even established players who do a lot of M&A might be tapping into the specialized individual whose role is to do either M&A or fill in other gaps within internal company or private equity firms' legal function. So
Yeah.
I can see that same being replicated and even being enhanced more and more on the fractional CFO side.
Yeah.
Yeah,
Helpful.
I
Thank you.
definitely agree with that. I think that many companies we're seeing have an array and range of advisors that are available to handle different type of mandates that come up, right? And so more and more you see, often it's referred to as like overflow counsel or overflow support, right? Where maybe, there's a counsel in place, let's say on, the M&A matters, but on the day-to-day matters where, more internal guidance is required, or even on the governance side of things, especially for general counsel, right? They could have, fractional counsel or internal counsel in place that supports that aspect of the business too, right? And so I think that that's one of the great things about, the marketplace that we're in right now, which is with these different roles coming up that maybe weren't as defined or there before, when Rishi and I started out in law school together. I don't think we heard about these roles or that we were educated on these roles quite as much. It was a bit more of a, large law firm or potentially in a public, a government type of role. And it was a bit more kind of like a 2 or 3 path type of option. We're seeing with the different flexibility of career options available, whether it's through tech or whether even through COVID, being able to set up remote and virtual services for companies, that there's all these different niche and pockets of expertise that are now available to clients. I think it's a great thing. I don't view that as necessarily a competitive aspect from my lens in terms of working at an external sort of full service law firm. I think there are different fits for different mandates that clients are looking to get support on. And just like in the CFO world, in the fractional CFO world, on the legal side as well, we see that. And I think it's great for clients to have that optionality for sure.
Yeah, one thing is certain, like every deal is different. And
Yep.
the complexity can get pretty significant here. I feel like so much so that we can probably do another session of this, and maybe if you guys are willing to come back, we will. But maybe before we go, want to hear from you on just that kind of classic question that I just love to hear your thoughts on, and what advice would you give to your younger self? And you guys are kind of interesting because you started out together, and Rishi, you've kind of taken a step outside maybe the path you started. Do you regret it, or do you look at Gary and say, oh, thank God?
No, I think it's what excites you and interests you. A mantra that I've always followed is I view life from 80-year-old self as opposed to my current self, and it's always looking backwards. If I'm 80 years old and I'm looking back, would I have regrets, or would I have wished I had done something else? And that's the advice I give to a lot of my mentees is, earlier in your career, don't be shy to take risks. And risks doesn't mean you're moving constantly. I was at a law firm for 8 years, but risk could also mean that wherever you are, taking on the stretch projects and not being afraid that you might fail, because all of those are learning experiences. So really getting out of your comfort zone and horizons and building that muscle early on, I think really leads to a fruitful professional life in the long run.
Great answer. Gary, that's going to be tough to match. But
I was gonna say that was quite well said. No, listen, I think like every day I think is an opportunity for people to learn professionally, personally, right? And every relationship is a potential networking or client opportunity in the future as well in the professional, service world that Rishi and I are in. And so I think just like looking back on it, really just honing in on those relationships from an early stage in your career, even like going back like just in school, right? And your classmates, whether it's in your undergraduate degree or in our case, we went to law school, so your law school classmates. So you never know where, a client or work opportunity can come from. And I'm a big believer that we're a product of those who we're surrounded by, whether that's our family, friends, and our network, which includes our clients as well. So investing that time early to build a strong reputation for yourself in the job you're in, to build a strong network, I think sets the foundation for a successful and happy career. That's the way that I think about things. That's the way I try to approach things. I mean, I still feel very early in my career with probably at least, 30, 35 more years to go. So I need to, practice what I preach. But I do feel strongly about that just investing, appreciating just how much those relationships and, investing in them and planting those seeds plays such a big role down the line in our careers and in terms of, our happiness surrounding our careers and general wellness is something that's really important to hone in on. And that's probably, if I had to speak to my younger self, would be having that discussion.
Well, shout out, gentlemen, to ACG, because that's where I had the good fortune to meet you both. And so I couldn't agree more. Guys, really pleasure doing this. Thank you very much. And hope you'll do it again. And yeah, thanks so much.
Well, thanks for having us, David. This was a great conversation.